Manishi Chaudhary joins us, Head of Research with BNP Paribas Securities. Manishi, morning. Thank you for joining us. Manishi, what is your understanding? Do you think the easy money is now behind us?
I think from now on, at least in the near term, the market should consolidate. There are several factors. I think, there's a degree of expectation building up that there would be positive action by Reserve Bank of India in easing monetary policy in late October. Secondly, I think in the upcoming result season, you could actually see some downgrades, particularly in the consumer discretionaries, particularly in the two-wheelers, and also somewhat in the banks and financials, more so in the public sector bank side. And third, as we go along towards the US presidential elections in early November, that concern about the fiscal cliff in early 2013 and how to sort that out, those issues will again come to the fore. So all these things should lead to some kind of consolidation, not just in Indian markets, but possibly entire emerging market universe after this significant rally that we've seen. And India has been one of the biggest outperformers in this whole scheme of things. That said, I don't really expect a major correction. One of the reasons behind that is there's a lot of money still waiting in the sidelines to be invested. There is a significant portion of the investor base who have missed out on this rally, and therefore the temptation to buy into some of the the high beta frontline stocks after a correction could be immense. We know that there are domestic institutional investors who are sitting on a lot of cash. So when that happens, when the investor base waits for a correction, that correction, even if it happens, turns out to be shallow. So that is actually our point of view on the market in the near term, in a nutshell.
So Manishi, what is your view in terms of what sectors would actually hold out and aid the market move upwards from here?
I would bet on autos selectively, particularly the four-wheelers, not at all on the two-wheelers. I would also bet on the private sector banks and a combination of the infrastructure financing and the housing finance companies. So, the likes of ICICI, Axis, LIC Housing Finance, Power Finance Corporation, IDFC, etc. I would also bet on select utilities, particularly those which are, they're not into merchant power, but who are regulated utilities with a degree of visibility about the capex, their capex pipeline going forward. And finally, again, select engineering companies, more the frontline companies which have low leverage on their books, like, the likes of L&T, if they correct somewhat from the present levels.
Manishi, I have your model portfolio in front of me, and if I look at your model portfolio, you have included Maruti in your model portfolio. That's interesting. There are multiple challenges for Maruti. What makes you bullish on Maruti? Valuations, or you're hopeful that they'll regain their #1 spot?
You see, in this particular sector, I think competition is something that has to be taken for granted. No company in the passenger car market can have 50%, 55% market share for years on end. And it's quite obvious that the new players would obviously come up, they would launch products in the same segment, and they would try to nibble away at the market leaders' market share. So I don't think there's any question about that particular eventuality over the longer term. However, we think that there is space for quite a few other players as well, because the market is turned out to be significantly larger than what anyone anticipated. Yes, there has been some slowdown in the market in the first half of the year, but we think that over the longer term, maybe double-digit growth in the passenger car market of India is, it's to be expected reasonably. And the near-term or the medium-term advantage for Maruti is that, I think in his diesel vehicle segment, he has significant capacity. He has significant inventory of diesel engines, which would lead to margin accretion in the medium term over the next 2 to 3 quarters. And now we are seeing a trend of rupee appreciation, which is also good for Maruti as a consequence of the fact that he is an importer. And, and his, the cost of manufacturing would possibly go down as a consequence. So those are some of the reasons why we think that the earnings estimates for Maruti could get upgraded even further. In fact, BNP's auto analyst upgraded Maruti from a hold to a buy about a month back, around 5th of September. And since then, the stock has moved up 20%. But we think there's possibly more to come in terms of the earnings estimate upgrades.
I know in the market no one likes oil marketing companies. Markets in fact love to hate these stocks. But if I map BPCL this year has been a marked outperformer.
BPCL is something that we've had in the portfolio for quite some time now. And the reason is that BPCL is not just an oil marketing company. The whole philosophy, the way the company works is changing. It's becoming increasingly an oil E&P story, thanks to its along with its joint venture partners, it has significant oil reserves in Mozambique and Brazil. And I think increasingly that will become a bigger and bigger component of the driver of value in this. So this is one stock in the OMC space that we like, and that's precisely the reason why we've had this stock in the portfolio for quite some time. And there's no reason to change that in the immediate future.
Manishi, do you think for major averages we have a firm base in place, and irrespective of the news flow, 5,000 on the Nifty is here to stay, and let's say 16,000 or 17,000 on the index is here to stay?
Well, these exact numbers are difficult, questions to kind of pinpoint on, but 17,000 would approximately mean about 10% downside from here on the broader indices. And if we do have a 10% downside on the broader indices, it would mean, somewhere around 12 to 14% downside on the high beta stocks. Let's say an L&T or an ICICI Bank in the banking space, or maybe Tata Motors and Maruti in the auto space, and so on. If we really do get to that level, I think, some of those large cap frontline stocks would become attractive, and therefore we could see another round of buying, both from the domestic investors and from the foreign institutions into those frontline names. So I think, yes, around those levels, the market would again become attractive from a valuation perspective. It is currently trading about 14.5 times, and with the kind of correction that you're talking about, which is approximately 10% from here, it would mean that the market would trade at about 13 times, which, given the earnings CAGR of close to 10 to 12% going forward over the next couple of years, I think is a reasonable level to enter the market.
Manishi, expectations from Infosys this Friday? No guidance as well this time?
Well, I don't know. We're yet still working out the numbers. But I think, we don't really expect any major negative surprises this time. But at the same time, we have seen the rupee appreciate, and that could lead to some small downgrades to the entire IT universe going forward. But, as far as the first set of big numbers that are coming out on Friday and then on Monday, we don't really expect any major negative surprise.
So you're not expecting anything negative from Reliance Industries? Is it a good time to buy into the stock then?
No, I wouldn't exactly comment on Reliance at this point of time, because it's a combination of just too many moving parts. I would perhaps consider buying Reliance at at considerably lower levels, maybe with a 10% downside. Because the broader problems with Reliance are more on the fundamentals, petrochemical margins and refining margins. And, given the situation across the globe, and particularly in Asia with China slowing down, I think those are the variables that need to be, paid great attention to. And I think Reliance becomes attractive at a significantly lower level compared to where it is now.
Manishi, if I look at your model portfolio, you are maintaining a 28% exposure to banks, but you don't have a single PSU bank in your model portfolio. Now, that's a concentrated call. That call so far has worked, but what is the guarantee this call will work, in future as well? Because if Indian economy recovers, I'm sure the PSU banking space will also recover.
No, you have a point there, but over the next couple of quarters, we still remain concerned about the asset quality of the PSU banks. And that is precisely the reason why we don't have a single public sector bank in that model portfolio. No State Bank of India, no Bank of Baroda, etc. And in particular, we have seen a significant rally in the PSU banking space. Stocks like State Bank of India have moved up about 25-30% over the past 1 to 1.5 months. So I think in the near term, it may not really be prudent to enter these public sector banks. One should rather watch out for the asset quality related news flow in these public sector banks during the upcoming result season and possibly even beyond.
Manishi, which end of the market to your mind which has appreciated in the month of September and early part of October is only because of short covering and under ownership, and that sector or that group lacks fundamental base?
Sorry, which sector are you referring to here?
No, I'm just trying to understand that at a time when markets are up 8-9%, everything has gone up. Some stocks have gone up because of short covering. Some stocks have gone up because of a earning visibility. So which end of the market to your mind has only gone up because of short covering?
You see, there has been a lot of the kind of stocks that you refer to which have gone up purely because of short covering and under ownership. They're possibly in the public sector banking space or the second tier infrastructure and construction companies, the likes of Lanco or GMR, etc. We are not yet going full throttle into those stocks. So when we talk about macro trades or adding beta to the portfolio, we are still being more judicious about the stocks that we select. So, for example, in the banking space, we took banks up to neutral, but the stocks that we added are relatively low risk in terms of their characteristics. LIC Housing Finance doesn't only belong to the relatively low risk segment of the banking portfolio, it is also relatively attractively valued compared to the market leaders. Similarly, as I mentioned, we went overweight on autos with Maruti, but that's a real good quality stock, with excellent management quality, and where we anticipate earnings estimates increasing going forward. So while we have added beta, we would still stick to the quality end of the spectrum, and we would stick to those companies where we do see potential earnings upgrades in the near to medium term.
Manishi, final question. Let me point out the odd one out from your model portfolio, and this really is the odd one out. Oberoi Realty. No one likes real estate stock. There are corporate governance issues. You're insisting that you like companies which have good, management, good management bandwidth. Then go for a real estate stock.
See, in the real estate entire sector, one has to be discerning. Among the large cap frontline stocks, there's a lot of concern about management quality, but if you go down the value chain and look at the mid caps in real estate, there are a few who are actually cash generators, which is kind of a rarity in this real estate space. So when you look at companies like Shobha or Oberoi or Prestige, there isn't so much of a management quality related concern that one may have with their larger peers. On top of that, these are some of the few stocks that generate cash on a regular basis. And this is what we find attractive in the name. So, among that universe, we have selected relatively the one that is relatively cheaper and has a visible catalyst going forward.